Okay, students, so we'll start with the new standard Ind AS 101 first time adoption. Okay, so before that we will start with bit theory. Okay, some theory we'll try to understand, but we'll focus more on the problems here, because theory you may get more confused if we straight away start with this theory. Yes, so here we have to first understand something called a transition date, and then first time adoption rules. See, if you go into this chapters, there is so many things. Okay, there are so many things involved, but let us focus, because if you see relatively the number of questions which has come is very low. 1 or 2 questions have come, but nice important high probable questions are there, and theory questions also which is highly probable will focus, but academically going more into it, it's like it's too much actually. Now what is a transition date? Okay, first up, what is this first time adoption? See, first time adoption is very simple thing concept. Like you are into you are preparing financial statement, what as per say accounting standard. Now Ind AS becomes applicable to you. Why? Because of the turnover criteria, whatever it is. Now the moment it becomes applicable, you cannot continue to prepare accounting standard. You have to prepare the Ind AS. Now from which day you are going to prepare Ind AS? Like for example, it becomes applicable this year. So this year is what? Say for example 2024-25 financials, what you prepare. That means the balance sheet which is ending on 31st March 2025, that should be Ind AS compliant. Now if I have to do that, where the opening balances are going to come from? It will come from the previous year 2023-24. But my previous year closing balances are all accounting standard balances. Then that means logically I have to restate everything now. Entire balance sheet I may have to restate as per Ind AS. Followed, no? How that restatement logic works we will discuss. But before that, I need one cutoff now, because there will be certain restatements going to happen, not everything. Now if it is going to happen, which opening balance is going to change? It is going to change from 1st of April 2023. That means have we come across in 116 transition? Modified approach, retrospective approach, modified retrospective with alternative 1, alternative 2. See, because accounting policy changes also. They said account it retrospectively. Retrospective means what? It's not that from the time immemorial, last year's first balance. That means now what happens, up to 31st March 2023 balance sheet, which is prepared as per accounting standard, you have got some X balances. Now you will prepare from 1st of October 2023 all balances, whatever you will do as per the standard, and you may get Y balance here, and the difference between this X and Y would be adjusted in the retained earnings. Now it can be full retrospective, like full retrospective we have seen, no? From 1990 you start, you check what is my balance on this day, differential you trade to the retained earnings. Or it can be modified retrospective, from this day only you restate it. The same like 116 we discussed. So it is very important, students, to understand the transition date, otherwise you will get confused while solving the problems. So what is my transition date? The standard says it is the beginning of the earliest period, which is 1st April, where you present full comparative information. That means last year's first. So XYZ has to prepare the financial statements from 1st April 2011. So 11-12 is the one where I am going to prepare the full financial Ind AS financial statements. So first time adopter is XYZ, and my opening balance sheet date will be 1/4/2010, and this is my transition date, because you have to pass certain accounting entries on transition date. So it is very important you have to figure out the transition date, and reporting period is 11-12 and comparative period is 10-12. So my 11-12 is the first time Ind AS here, full Ind AS there. 10 level will be comparative last, lot of restatements, reclassification must have happened. And 1/4/2010 is the transition date. And now, if this auditor is different, 31st of March 2000 auditor is different, and here you have changed one new auditor, now you get into one more headache. Call that auditor, get it re-audited. Present auditor cannot do it. If on that day, if your auditor was different, you have to call that person, and that auditor has to give one revised financials as on 31st or 1st. Are you clear? Yes. Now we will talk about the first time adoption rules. Okay. So what? See, there is so many things. See, conceptually, Ind AS is to be applied retrospectively. However, to ease the process, because otherwise my life is going to become very much problematic here as an accountant. I will just immediately resign the company, because it may not be possible, so much of burden. That's why to ease, certain exceptions and exemptions are given. So let us not get into the details of exceptions and exemptions, because academically it sounds very nice, but it will look too much confusing. That's why what I have done, wherever applications are there, either theory questions or practical questions, I have taken that extract, what adjustment we need to do. So you learn as of now how to solve the problem with the transition, and you learn how to write a theory answer. That's sufficient at this point of time, because we are not going to do any transition now. Transition, majority people who had to be done, that is already done now from 2014 onwards. Okay, let us learn how to do that. What is the logic behind it? So that again you will come across something new, at least you understand. So let us take one by one. Change in the estimate. Estimates as per the Ind AS and previous gas should be same. Now, how it will be different? What you done estimate as per accounting, like reserve for bad debt was there. As per accounting standard, you made certain estimate. So many people may not pay me. Is it different from accounting standard? Estimation same. So any new information received of previous estimate shall be treated as a non-adjusting event and prospectively you apply. Don't retrospectively you change. That means again, change in the estimates are not going to adjust it. You adjust only this year, not last year's opening day. Retained earnings effect is not going to come here. What about the government loans? Now entity shall prospectively split the loan, that means from this year, not transition date, into Ind AS 20 and financial liability. Have we done government grants? Interest free loans are given. I don't know under accounting standard what was the procedure, but here we are very clear. When government gives you interest free or subsidized loan, you have to split between two. Now if any government loan is existing on the transition date, should I do that? The standard says you do prospective. From today's day you do. They have one exception. Entity may apply the requirement of 109 retrospectively, that is splitting, if the loan is originated before the transition to Ind AS. Like last year this loan has come, leave it. Somewhere before the transition only has come, then you can do. However, it is applicable only when you have got all the information of such loan to split that. Means on that day you need to know what was the corresponding market rate of interest. Do you have such information? Then you split it. Otherwise you don't get into split. That means if the loan may be previously, what accounting entry you must have passed under your accounting standard when the loan was received. Bank account debit to loan, 10 rupees, 10 rupees. Ind AS what you should have done? Bank account debit to 10, loan 9, government grant 1 or deferred government grant 1. This should have been your entry. Now question is, on the date of transition, should I pass this entry? There is an option. Okay, if you may apply retrospectively provided you have got all the information. Otherwise, you do it prospectively. Okay, later on you can split. Business combination 103 need not be applied combination before the transition. Good. Otherwise, lot of headache, consolidations, everything would have got changed. Like whatever balances are coming from the previous balances, no, you take it as a opening balance. Again, don't get into any retrospective adjustment. There should not be any change except from the subsidiary to joint venture. Assets and liabilities at the carrying amount as deemed cost, whatever book value was there, you do it. If entity restate any business combination, then you have to restate all the business combination. I'll give you, if you want simple life, I will tell you, don't touch any business combination. Whatever business combinations you have done, continue with that. So what all balances are shown in the balance sheet? I don't know. It is coming from your accounting standard. Okay, from now onwards, I will treat it as an Ind AS balance. But if you want more pain to yourself, want to restate, do it. But all the business combination you should do. Selective basis to get the accounting effect, you cannot do it. When the parent entity has not consolidated an entity as a subsidiary in accordance with the previous GAAP, then subsidiaries assets and liabilities would be included in the parent's opening consolidated at the carrying amount of the separate SFS. Is it possible like this, that parent has never consolidated one subsidiary? When? How it's possible? That in accounting standard they didn't do, but in Ind AS they have to do. See, no, accounting standard goes with your 50% stake. You need to hold 51%, then only it is subsidiary. Ind AS goes with the concept of control. You may not hold anything, but still it is your subsidiary. So you may not have done one CFS, and in your CFS, one subsidiary was not included, where the accounting standard was talking about the rules there. Parent is to say, look, I am holding only 40%. Angel Limited example. Little Angel, Pharma. Parent says, look, I will not prepare CFS. Why? Because it is not my subsidiary. Look, I am holding only 40%. It is my associate. But Ind AS says, no, Baba. Even though you are holding 40%, show me your, what is that called, pattern. As per this AGM pattern, you are the controlling stake there. Means you are the majority minority. So you have to consolidate. If that is the case, I have to get one subsidiary's values, no? Which values to get in my opening balance sheet? Standard says, okay, Baba, don't go and develop on fair values, because generally when I get the subsidiaries values in my financials for the first time, as per 103, I have to get a fair value. Now this becomes a big headache. Suddenly, because of the change in accounting rules, one subsidiary, which I was treating as not as a subsidiary, becomes my subsidiary. So the standard says, whatever their subsidiary separate SFS, whatever their book value was there, take it as your fair value in CFS. Clear? So this question they may ask you for theory. Now for the purpose of subsidiaries SFS, for this purpose the subsidiaries SFS would be prepared as if it is a first time adopter of Ind AS. So first let them first prepare as per Ind AS, because you are into Ind AS. You can't see, if Ind AS becomes applicable to parent, it becomes applicable to subsidiary also. If subsidiaries financials are to consolidate, they also should be in. So first you let them become the first time adopter. It goes like a chain now. If a parent becomes a first time adopter later than its subsidiary, the entity in its CFS shall measure the assets and liabilities of as the carrying out, because already by that time, see, subsidiary was already into Ind AS. I was not into Ind AS. Now I have become into Ind AS. Now when I come into Ind AS, you are already there, no. So you are not, subsidiary is not a first time adopter. So whatever their book values are, they will straight away take. But if Ind AS becomes applicable to parent first, then I have to take subsidiaries SFS. That subsidiaries SFS treated itself as a first time adopter, convert yourself into Ind AS and get that value into CFS. Have you understood this? Confusion? Which one? Okay, we can discuss it. The parent does not change the amounts already recognized by the subsidiary. See, the problem, one examination question is there for you, which is with the joint venture. I think it must be there. I just tell you what it is. See, in your associate and all, you don't have any problem, but joint venture is, previously in accounting standard, you are following proportionate consolidation method. You remember that? Suppose if you have got a joint venture and you have invested 50% in this, have you prepared a consolidated balance sheet? In that CFS, how much you have taken? 50% of the joint venture. But Ind AS says what? It's an investment. Ind AS 28 has to be applied. You cannot take their proportionate net assets. Now you have to de-recognize their assets in your CFS, because already in the parent CFS, joint venture values were there. You have to de-recognize and recognize investment in associates. There is one question on that. See, again, when I am talking now, it looks more imaginative. You have to sit and imagine here. Again, I thought initially I will not teach only. I told you previously, I will surrender. But later when I started to solve the problem, no, that gave me better understanding. So if you are not understood certain things, just leave it. When we are solving problem, we will come back again. Followed, no? Same thing is applicable. That's what they said, no? In that 40% example, you have to take now SFS, you have to consolidate now. Now, what about the goodwill? The carrying amount of the goodwill shall be the previous gap after 2 adjustments. Whatever was there in the previous gap consolidated CFS, take the same balance, but if any intangible assets were there, which were earlier sitting in the goodwill, you didn't recognize because of some reason. Like for example, you have got this reacquired rights. What is reacquired rights? Do you remember? In 103, what was that reacquired rights? You have got one franchisee. You are given one Vada Pav Limited, one subsidiary, one franchisee is there. You acquire your franchisee only. So in this process, that at the CFS level, normally nothing happens, but at a CFS level, McDonald's, you think that your asset license have come back to you. So you have to recognize separately now. Goodwill balances are going to come down. So asset has been recognized as an intangible asset under previous gap, but it is not permitted. Then these all adjustments, no, you have to do it. Further, regardless of the impairment indicator, you have to apply Ind AS 36 and test for impairment and take the difference to P&L. Because on the date of transition, you have to test the impairment. Once the goodwill is recognized in the opening transition date balance sheet, entity has to follow the provisions of 36. That means only amortization, only impairment, no more amortization. Previously, you might have been doing amortization. Eventually, it must have come down to some X balance. Leave it. I will just take the balance. Test the impairment today. I will take the balance. Are you getting, students, getting connected? Now NCI. My problem with the NCI previously, if NCI, I cannot show negative balance. They were called minority interest. But I can take it in case entity elects not to restate the previous business combination. See, if they restate it, automatically NCI will get restated. Goodwill also get restated. Otherwise, I can take the previous goodwill as it is, NCI as it is. You will measure the NCI follow from the other assets and liabilities. Like whatever you do from there, it is going to come. The carrying amount of the NCI in the opening balance sheet cannot have a deficit at balance account on account of loss attributed to the minority interest, which was not recognized under previous gap. So previously it was not recognized, negative balance. So that is not going to happen. You cannot have a negative balance at the opening. Later you can have. Now share based payment transaction, 1 not, 2 we have seen. In case shares are already vested, entity may elect to carry the same balances as per earlier gap. So you have been passing accounting entry, employee expense account debit to ESOP reserve, employee expense to ESOP reserve. And if you had got vested, then whatever ESOP reserve balance is there, you please take it. However, if it is not vested, then you have to restate retrospectively. So this is one retrospective adjustment has to come. That means on the transition date, what was its value? That you have to consider. Difference between the previous book value and this will go and get adjusted in the internet. However, if the first time adopter elects retrospective restatement, it may do so only if the entity has disclosed publicly the fair value of the instrument. So I should disclose, is the theoretical part, fair value at the measurement date. Followed, no? Again, see, all these adjustments somewhere either theory question or practical questions are there. When we do the practical question, I just tell you again, I will remind you, look, this is that point. Then we have got a deemed cost of PP, biggest amount, because any balance sheet you take, PP is the big value. Retrospective application, it says that entity shall measure the items as per Ind AS 16, 38, 116, retrospective. First of all, they say retrospectively you go and measure. This measurement option can be applied on item by item basis in a class, like plant A can be measured retrospectively. Plant B can be measured applying the fair valuation or revaluation option. Like today's day, I will help you to convert. If you want to get into fair valuation, you can get into fair valuation. You have been doing cost under accounting standard, shift into, because anyhow, it's the retrospective, no? Your change in accounting policy is also retrospective. So if you want to shift from cost to revaluation, you can do it. Now, fair value measurement at the transition date, this also can be applied on item by basis. That means you want to revalue factory building, but want to show office building at cost. Can you do this? Ind AS 16. Factory building, you are doing revaluation. Office building, you want to maintain at cost. Can you do this? You can know this one. There is one exam question. In day 16, we can do it. One question was there. Class by class, you can do it. That's why you can apply this here also. Now, what about the previous gap revaluation? This can be applied on an item basis if the revaluation date, revaluation is broadly compared to fair value less cost or depreciated value as per index adjusted to general or specific price change. Okay, some theory, leave it. Now, previous gap carrying amount can also be adopted as a deemed cost, provided there is no change in the functional currency. Okay, I will give you one simplicity, because by default I am telling you go retrospective application. Retrospective application means it is an item by item basis. It is a big work, no? So what is the benefit for you? You take whatever balance, I don't know how did you get it in accounting standard. I'll give you one option to you. By default you are supposed to restate. But what is one option? Whatever balance is there in your balance sheet, no? Take and start as a index balance. This measurement option can be applied only if to all the asset classes and items and not on selective basis. See, one option I will give you, if you want to do selective basis, then go for retrospective. Then retrospective you can do convert from cost to fair value to cost, class by class. Alternatively, what all balances are there, you adopt it as it is. There, item wise item will not permit. Only any fair value increase in the PP is recognized in the revaluation surplus. Because if there is any fair value, you want to, like previously you have valued some asset at a fair value. Today you will find some fair value. Yes, it will go to the revaluation surplus. On changing from the revaluation to cost model, the revaluation surplus will be retained in the move to retained earnings, no recycling. See, always this movement is permitted. Revaluation to cost, cost to revaluation, because you are in the transition date. Because if you change it today, ultimately retrospective means what? First of all, friends, what do you understand by retrospective? From the last year's first balance sheet. So all these changes is permitted. Entity can allocate cost to a component based on the fair value. Suppose if you want to follow component accounting in day 16, that turbine and all, I don't know whether accounting standard permitted or not. No, they might have done it. But if you have not done that, you want to do it, yes, today you can start applying component accounting based on the fair value of the transition date. However, different entities within the group can choose different bases of deemed cost for their standalone. That we have discussed in India's consolidation chapter also. Like parent is following SLM basis, subsidiary is following WDV basis. Is it permitted at a consolidation level? Yes, because it depends upon the asset. No, again, accounting policy has to be harmonized. But depreciation is not a policy, no. It goes with the consumption of the machine. Estimates. But FIFO and weighted average, if both are different inventory, fine. But if both are same in inventory, like MRPL and ONGC, MRPL is following weighted average for crude oil and they are following FIFO for the crude oil. Then consolidation should happen with the crude oil, FIFO. In the consolidated financial statement, entire group should be treated as one reporting entity. Like fair value, land we can do retrospective building, fair value, retrospective. So you should go class by class, but on a retrospective basis. Previous or take all the PP at a previous gap value. If you want to do fair value or retrospective, you can do item by item basis. So cost model is there, revaluation model is there. Ind AS option 1 retrospective, it is not change in the policy. So revalue the fair value on the. Okay, so we'll come back to this when we solve the problem. Investment of property now, Ind AS 41. The measurement option available to PP can be applied to investment property also. However, problem with Ind AS 41, they don't permit fair valuation. Sorry, Ind AS 40. They don't permit you fair value. So class by class application of the fair value cost model not permitted to you. You have to carry only, or alternatively you can take the previous value as your new value. Decommissioning liability, obligation should be capitalized as per PP, separate component. discounting using the estimated best rate, accumulated depreciation should be calculated, any difference should be charged in the retained earnings. Alternatively, okay, so this is mean you calculate again full and do the accounting. Alternatively, you go for deemed cost exemption. Like whatever balances are there coming from the previous, you take it. PP should be restated to the fair value with the corresponding adjustment to the retained earnings. Management need to ensure that the fair value was the gross fair value and not the net fair value. We have done this in day 16. Gross value, fair value is what? What is gross value? Asset is separately valued, liability is separately valued. Net fair value means you minus both and give one valuation. Management would recognize the provision in Index 37, no cost in respect of provision to be added to PP, recognized in the retained earnings. Yes, coming to exchange difference, Index 21. The first time adopter may elect to continue accounting for exchange differences from long-term monetary foreign currency item as per previous cap. So now what is the catch here? This is what you are going to find. Now, as per our accounting standard also, any changes in foreign currency, suppose you have taken one foreign currency loan. On that foreign currency loan, there is one foreign currency gain or loss is going to come. Say forex loss comes now. What accounting entry you pass? To loan you do, because it is a loss. Liability balance is debit what? As per accounting standard. Now you have taken this loan to acquire one foreign subsidiary. Now you will tell, sir, this is the specific borrowing cost. But investment is not my qualifying asset. Investment is not a qualifying asset. You understood the catch here? Now, accounting standard said very clearly, look Baba, whenever you take a foreign currency loan, debit to P&L. What my index said? Debit to P&L. Both said the same. You have to pass this accounting entry. Followed? But one of the company didn't want this. They wanted to debit PPE with some extra logic. They came to ICA. They said, please, can you amend the accounting standard? Can you permit us to give this option? ICA said, no, Baba, how meaningless? We cannot permit this. This is the accounting standard story. I'm telling you, if you are interested, please check in the Google about this. Then this company went to Ministry of Corporate Affairs. Ultimately, who has to give the accounting, who has to prescribe the accounting standard? We will give, Ministry has to, it got amended. So there is one para number 46A or something. And they permitted companies can capitalize forex loss. Forex loss, which was not permitted. That's why you see one difference here. They say that, you see, this is you need to understand because this is coming from your work. Other theoretical, I am just rushing away because more theory I speak. Loan means originally loan was taken at that time dollar was 50. At the end you didn't pay the loan and dollar has become 60. So you got a loss no. In Index 21 we have done that. Unrealized loss. Now they say that the first time adopter may elect to continue the policy adopted for accounting exchange difference on long-term monetary currency items as per previous cap. Now, what policy it is? That's why the previous accounting standard gave you two options. Either you capitalize or you charge to P&L. Obviously, people would love to capitalize, no? They don't want hit in the P&L account. Increase. Yes. Depreciation, but it is over the life, no? Then you talk about impairment. See, impairment headache doesn't come unless there is an economic crisis. Always you project good cash flow, no? Your value in use is much more. Master plan is there, followed, no? Depreciation will come, but it's spread over 10 years, no? That means you are amortizing this cost. Now, as per accounting standard, exchange difference can be capitalized, which was an optional, but Index 21 do not permit it. Now on this transition, if the previous carrying amount need not be adjusted for exchange already, so if you have already capitalized it, then don't get into restatement. Standard says, okay, please continue now. We cannot burden you. Now one more thing they said, like we will give you two choices provided by 101, which are independent, like deemed cost of PP and exchange difference on accounting. Like on the exchange difference is sitting where? In your deemed cost. Now, sir, if I take these previous balances of that capitalization, should I continue with that at a deemed cost? No, they said that if you want to do fair valuation for PP, do it. That and this you don't connect. Okay? Because here I said no, that you can take the previous balances as per the previous accounting policy choice. So that is not required. You continue. The capitalization of the exchange difference as per the previous gap was an optional, and you cannot opt retrospectively on the transition. Now you don't tell. If you would have taken that policy, then only I will permit you to capitalize further. Means do this adjustment. Company can avail the exemption under 101 by continuing with the previous accounting policy for capitalization only if such was adopted and not with retrospective. That means today, if you see, Ind AS 21 doesn't permit capitalization. Correct? Have we discussed anywhere capitalization? No. But as per 101, if as per previously you had an accounting policy to capitalize for excess, in Ind AS also you can continue to capitalize, which is an exception. But can you take this exemption now? No, you should have already taken in accounting standards. Now you cannot tell, sir, give me this exemption. First I'll ask you, have in accounting standard, have you taken this policy? No, then don't talk, then capitalize, charge to P&L. And in this option, like if there is one option to you, if any of the balances lying in your FCTR, foreign currency translation reserve, I will permit you to make that balance zero by transferring that to retained earnings. This is one option. If you, in the question they said that they have opted for it, you have to pass one journal entry, retained earnings account debit to FCTR or FCTR account debit to retained. Are you clear about this? Now investment in the joint venture, I told you, because previously proportionate consolidation method was applicable, but now Ind AS investment in joint venture 28 is applicable. So you have to de-recognize, including goodwill, of all previously recognized value and recognize one item called the investment in joint venture. Okay. Now come to financial instruments. Entities permitted to designate a previously recognized financial asset to measure at FVTPL based on the facts and circumstances. Like already you have taken, you can permit it to designate like previously recognized financial asset, like FVTPL or whatever it is, FEOT is, MAT is cost. Further, if it is impracticable for entity to apply retrospectively effective interest method as per 109, the fair value of the financial liability on the transition date shall be the amortized cost. Now you have taken this loan in 1995, it is still continuing. And you must have shown at cost, but today you should show at a fair value. But retrospective, I don't know, sir, what was the interest rate in 1995? No problem, you take today's day effective interest rate and check the fair value, and that is going to become new fair value. Any differences in the book value and that fair value will go to retained earnings. On transition, financial assets are measured at a fair value except subsidiary associates, which can be measured at cost as per Ind AS 27. The subsequent measurement of such assets are based on categorization, which is business model test and CCFC test. After transition, if any new assets come, 109 becomes applicable. The last one is the compound financial instrument. So the first time adopter need not split the compound instrument into equity and liability if the liability component is not outstanding on the transition date. If it is outstanding, then you may have to split. Yes, so these are all the provisions. See, I understand. Now you have to sit and just imagine what it is, how we are going. It's too much theory, but without this, I cannot simply go. Now, did you get one fair idea? Yes, now we will take up problems and solve the problems. Which one? Yeah, I'll share it. Almost done now. 3-4 chapters. No, afterwards I'll share the book only. Yes. So take out question number 1. This is an example question. Government of India provides loan to MSMEs. What happened? Below the market rate of interest to fund the setting up of new manufacturing facility. Now, company A's transition date is 1st April 2015. So, what is your financial, India's financial statement date? 16-17. So, 31st March 2017 balance sheet is the first India's compliant balance sheet. So, all retrospective adjustment you have to do it on 1st April. Now, in 2012, the company, some 3 years back, company received a loan of 1 crore rupees at a below interest rate. Sorry? 2012, no? This is, see, if this is your transition date, if 1st April is the transition date, which is your financial year in which first full balance sheet you would have prepared in the Ind AS? 15-16 is the comparative year. So, if you have got current financial year, what is your financial year? 2016-17 is the current financial year, which is getting audited and signed. That's what I'm telling you. Please understand, the transition date is very important. 2015-16 is the comparative period for the sake of comparison. And all the adjustment, wherever you touch for retrospective, will be adjusted on 1/4/2015. This is called a transition. Now, if you are that auditor and current auditor is same, well and good. Otherwise, that you have to call this previous auditor and get this audited. And because of this, your opening balances for this is also going to change. This is also going to change. There are certain options where on 31st March 2015, whatever balance was there, I could have taken. See, if Ind AS would have given me one option, whatever your balance sheet on 31st March 2015, let all the balance become the opening balance of 1st April 2015. This chapter we should not study on. Life is simple, no? Let me straight away, if this is your opening balance, this is your opening balance, and this is your opening balance. So from now onwards, I will try to apply it. But the standard didn't tell you. Standard told you, look, item wise item, I will tell you adjustments. I cannot tell you like this. Unless I tell you, see, there is something compulsorily you have to do prospective, something compulsorily you have to do, optionally you have to do prospective. If not this, by default, everything retrospective. Which one? No, they have given you option, like, see, you have to consider the practical difficulty also, no? No, you could have taken, but there are certain items you may have to restate. And somebody, like, their policies may not be suiting to us. Certain things we may have to clean up the balance sheet. Some transactions are accounted in totally different way. It doesn't make any sense here. Like, for example, this compound instrument or whatever, your loan at a below market rate. Okay, so now in the year 2012, you have taken one loan, okay, of 1 crore at a below market rate of interest. So this was a government grant as per Ind AS 20. Under Indian GAAP, the company accounted a loan as an equity transaction. And the carrying amount of 1 crore at the date of transaction. What is the book value today? 1 crore. So what they have done, what accounting entry they have passed? Bank account debit to loan, and loan is shown as an equity contribution by the government of India. The amount repayable on 31st March is 1.25 crores. Now determine how the said loan will be accounted. Followed? Okay, so now Here, since the information about the market rate of interest is not available in the question, splitting of the loan into grant and liability, we assume entity has opted not to split. See, there was one option. So the option goes like this. So maybe I'll share this. You have to refer from time to time whenever we do the adjustment. The option is the government loan. This part you have to apply. What it says? Entity has to apply prospectively, split into two components. Entity may apply the requirement of retrospective. That means from 2012 only you can go back and split and check today how much would have been my government grant would have charged to P&L. See what they should have done. They should have split this into two portions. One is government grant, another is your loan. What you should have done with the government grant? Every year you should have taken some portion to P&L account as per Index 20. What you should have done with the loan? This loan should have been at the market rate of interest, and amortization schedule you should have done. So you should see on 1st April 2015 what would have been my balance of deferred government grant income and what is my loan balance. That you should have incorporated, and the difference between your book value and that would have gone to retained earnings. Now they say that you may do this only if you have got information about the time when you initially occurred. Do you know in 2012 in this question what was the interest rate, market interest rate? You need a market interest rate. No, if you want to split this 1 crore into two portions, don't you need a market interest rate? Do you know? No. But now from now onwards, you should account it prospectively. That means you need not split it. But if this 1 crore was your financial liability, what they have treated it, they have treated it as an equity. They are not recognizing an interest expense. Can you do this as per Index 7, Index 109? No. Is there any interest component? Yes, how much? 0.25. So this should be expensed from now onwards, because we have not opted for retrospective restatement. If at all you wanted retrospective restatement, then you should go to 2012, split this into two components. One is the deferred income loan. Deferred income every year you should have taken to P&L account some portion over the useful life, conditional, unconditional, that you should have checked. And this loan you should have amortized from that day. Okay. What was the fair value of the loan? God knows, because 1.25 is the contractual rate payable in 2019. You should have seen in 2012 what was its present value at the 2012 rate. So since they didn't tell you 2012 rate, are you understanding? No, we are not going to split this in 2012. We are not going to prospectively, we are going to account it as a loan, but we are not going to split it. If you want to split it initially, if you have the information. Okay, so right. Solution. The loan is financial liability as per Ind AS 32. So needs reclassification from equity to financial liability. Have you understood? The loan is the financial liability, no? Because there is a contractual obligation to pay cash. Because you have to pay in 2019 1.25 crores. But what was their classification? They have treated this loan as a equity. So you need a reclassification from equity to financial liability. You cannot show it as an equity anymore. It uses previous gap. Yes, Kriti, you want any information? Not understood. The loan is a financial liability as per Index 32. Full stop. So we need to reclassify from equity to financial liability, because the question said that they had treated it as an equity. So we need one reclassification. So what accounting entry I should pass? Where bank account? Bank account I didn't receive, no? Should I pass any account? For this amount is what? It uses previous GAAP. It uses, yeah, we'll talk about the journal entry also. It uses previous GAAP values as transition date book value. See, first of all, we are going to tell that this loan is a financial liability as per Ind AS 32. So we need to reclassify it from equity to financial liability. So what accounting entry I need to pass? I need to pass an accounting entry, equity account debit, loan to loan, financial equity bracket financial liability. At what value? We are not going to opt restatement retrospectively. Otherwise, government deferred income also would have come here. Entry would have been to deferred income. Which amount? You consume it and check what should have been today's balance. That you don't do. Why? Because you don't have 2012 information with you. So now at which value you will take? At 1 crore only. Followed, no? So that's what the second sentence you write. It uses previous GAAP book value on the date of transaction as the carrying amount of the loan in the opening balance sheet. Now 0.25 what to do? Going forward, you have to charge it as an interest expense. So we need an EIR. So annual EIR is calculated as below. Yes. So what is my IRR or EIR? Can you tell me, students? Easy, no? Morning we have done 1.25 divided by 1 to the power, because it's the one time, no interest payments in between. How many years? We are when this is when we are accounting from today, no, 1st April, 4 years. 2014, 16, 17, 18, 19. 1 by 4 minus 1. You are clear, no? How? Because what is your transition date? 1/4/2015 is the transition date. Will you apply retrospectively from 2012 onwards? No. Then these balances would have been different. Accounting entries would have been different. You will apply prospectively from today, from the transition date. What is the value? 1 lakh. So from today, if I have to apply, my IRR should be next 4 years, no, 2019, 16, 17, 18, 19. So if I solve this, very easy. How to get this? 1 by 4 square root 2 times. You get 5.74%. Very clear, no? See, this question is sitting in an example. Highly probable it may come for your exams. If it comes, just do this quickly, finish. But you understand what you're doing. Now, at this rate, what can happen? Rupee 1 crore will accrete to 1.25 crore by 2019. And interest expense will be charged to P&L next 4 years. You are going to charge the interest expense in the next 4 years. How do you charge? Amortization schedule. So how you prepare one amortization schedule. Yeah. They have prepared in the solution. I think it has come in the exam also. It has come in the exam. So you have got date from when? 31st March 2015. I'll write opening balance. What is my opening balance? 1 crore. But on which day? 15, transition day. See, that's why you asked me why we are not taking every balances. See, if I take every balance, I may take like this is a prospective only. But from now onwards, I will treat like an India's balance. Because transition happened on 1st April now. So 1 crore, interest cost will be at 5.74%, 5,73,713. 573,713. Closing balance will be 1 crore 5,73,713. Anyhow, this amortization schedule you are clear now. You can leave some space. Last you can say, at the end you can say, if it needs, it can apply retrospectively. All this thing they could have done retrospectively also if all info was available. Instead of doing this, no, in 2012 you could have gone, split this 1 crore, find out the present value of 1.25 when in 2012. Split into two components, financial liability, government grant. So on day one, your accounting entry is only one simple accounting entry. On do you pass any accounting? Okay, this is the theory you will write. On 1/4/2015, will you pass any accounting entry? Yes, only one accounting entry of reclassification from equity to loan. During the year, will you pass any accounting entry? Yes, interest expense, because in their accounting standard comparative, there was no interest expense only. But I will pass it now because I have got prospectively. So in the second year, 16, 17, I will pass it and automatically my previous year comparative is restated. Have you understood very clearly how this transition is happening? Yes, Aditya. Any doubt? Vishnu Priya? Which one? See, there were two options for me. If the information is available, I can go to 2012 and I restate it retrospectively. Means split this into deferred income, loan. How? By finding out 1.25 present value at market rate of interest on 2012. Then split this. And from then apply in days 20 here, in days 109 here. And check what was the balance today. You get those balances. So your accounting entry would have been loan account debit 1 crore, which is classified as an equity, to deferred income X amount, which would have been its balance, to loan financial liability Y amount. So in this process, definitely you will find some difference. What I will do with the difference? To retained earnings. That amount would have gone to retained earnings, Z. Z is nothing but the difference between 1 crore minus X minus Y. Have you understood? And from now onwards, how do I account? Last year, comparative year, deferred income into 1/4 I will debit to P&L account, or 1/10, whatever it is. How do I account this loan? I will prepare an amortization schedule, but I will find out one new effective interest rate, or whatever. My original effective interest rate I will continue, then I will continue. A second, you restated now on. No restate means no split there. I will treat entire amount as my loan only. It's easy, no? Okay, so please pause the video, students, and work out this. You have understood, no? See, same example question came in the exam, July 21. Students, the verb used here is discuss the above treatment and share your views as per applicable index. So it's the same answer what I have given, no? You have to write. But I wish you write just keywords like restatement, no, only prospective application. Then we'll compare the answers. Yes, so here there is nothing is much theoretical. Okay, so if it comes, you can first you say that look, you have to classify the government grants as a financial liability or an equity. Classify all the government loans as per Ind AS 32. You shall apply 109 and 20 prospectively. That means from 1st April 2015. And don't recognize the corresponding benefit below the market rate of interest of the government grant. Consequently, under the previous gap, if a first time adopter did not recognize and measure the government loan at a below interest rate of interest on a basis consistent with India requirement, it shall use the previous gap carrying amount and the date of transition as a carrying amount of the opening. And first of all, in this question, in the exam, they have added one para here, which was not there in the example. Just ignore. Somebody has given some advice of some ill accounting, debit increases the PP, it seems credit to the equity, something, or reduced to from the asset value. Or maybe they are telling when you pay, reduce from the bank. Which asset they are talking? Bank, not plant and equipment. The entity shall apply the measurement of such loan after the date of transition. So, in the given case, the loan meets the definition of financial liability. So, it should be reclassified from equity to liability. So, I would like to see one answer where you are going to speak about the reclassification. It also uses the previous carrying amount. Have you told that previous carrying amount has to be used? Yeah, otherwise you will pass one entry, but which value to start with? Then it has to calculate the EIR, which is 5.74. See, in the exam also same EIR came. At this rate, 2 crore will be. Did you get this EIR? So you have to prepare an amortization schedule, which 2 will start becomes 2.5. However, you may do the retrospective if all the information are available. The accounting treatment in the given and the advice which the company has been provided is not aligned with the 101. So somebody gave an advice, no, do this and all. So that is not as per 101. Anyhow, see certain places here and there, even though you have missed, you would have got that EIR, if you have told the classification, if you have told previous carrying amount, I think 5 mark question, no? 6 mark question, you should be able to reasonably get 4 marks here with all this and amortization schedule, or maybe 6 also, who knows? Language is complicated. Followed, no? That's why I use my this thing, no? I use my language. I have taken it here. In the previous, see again, this you need not state only, no? You straight away start with this. Take some risk. So 1 mark you may lose that. Not okay, 2, 4 also I said, no, 4 is a good number. Oh yeah, you have to, it will take time for you. So take a risk and leave some space. Yes, next question. This is also a very important question because in the first study material, there was some problem. For me, it was very difficult to explain. Then they changed it and it is given perfectly now. On April 2011, Sigma issued 30,000 6% convertible debentures of face value 100 rupees per debenture at par. In 2011, this instrument was issued. What is this instrument? It is a convertible instrument. Seems to be a compound instrument. Now the debentures are redeemed at a premium of 10% on 31st March 2015 or may be converted into share at the option of the holder. Chalo, by default it has become a compound financial instrument for you. But when it was issued in 2011, the interest rate of the equivalent debenture without conversion option is 10%. Now the date of transition is 1st April 2013. Oh, so before your transition date only, it was there. Suggest how should Sigma Limited account this compound financial instrument on the date of transition? Should you split this? Yes, we have to split this. Okay, previous was a government grant. There was a specific thing, but here the standard says, look, on the date of transition, is that liability still outstanding? Yes, outstanding liability was there. So you have to split this. Suggest how should you account the present value of rupee 1 at the end of at 6% and 10% is given. Which is relevant? 10%, because the market rate is 10%. No, 6% not relevant for us. Okay. Now, how do we split this on 1st April 2013? And what type of accounting entries are going to come? Let us understand. Okay. Write solution. Ind AS 32 require split accounting. Enough, no? You understand? As per 101, if liability is outstanding, retrospective restatement required. That means split accounting has to be done. So if there is a liability portion outstanding, yeah, generally it will be there. You have to do retrospective. First portion into cumulative interest into retained earnings. Second portion equity. So that means you must have charged some equity interest, no? As per this, you have charged some contractual interest. But what you are supposed to charge at the rate of 10%. So you have to restate the balances now. Okay, so this is the theory you will be writing in the examination if it comes. First time adopter and all. So first time adopter need not separate two portions if it is not outstanding. So applicability is retrospective application. First portion will go and second portion will go into this. Okay. In the given case, it has to be done. Okay, so you can write that liabilities outstanding. You need to split. So first of all, write one working note. What is the carrying amount of the debenture under previous cap? What is your book value today? So the premium, it was repayable at a premium, right? What is the question? They issued 30,000 convertible at a face value. The debentures are premium with the 10% premium. So premium on redemption is being accounted on SLM. So what in accounting standard they must have done? This premium you are repaying at a premium. How much is the amount of premium? 30 lakhs into 10%, 3 lakhs. What is the term of the instrument? When did you issue? 1st April 2011. When you are going to redeem? 12, 13, 14, 15. 4 years. Out of 4 years, what is your transition date? 1st April 2013. 11, 12, 2 years finished. That means out of 3 lakh, 1 lakh 50 you must have recognized as a borrowing cost on SLM as borrowing cost. As a borrowing cost. So, what is your initial loan amount? 30 lakhs. You have been paying some interest, leave it. As per accounting standard. Plus, if you have to recognize that 1 lakh, 3 lakh rupees as a borrowing cost, what accounting entry you must have passed? You understood here what is the accounting treatment? See, first of all, you took a loan on 1st April 2011, which you need to pay 2015. With when you repay 3 lakh rupees extra you pay. Will you recognize this as expense in the 2015 only? No, you must have split into 4 years. When you recognize any year, what accounting entry you would have passed? Is it an expense? Yes. So expense account debit. In a bracket you call it finance cost, borrowing cost, whatever it is. To what? Loan. Provision, no? You have to make a provision now. So what was your balance book value of the loan as per previous gap? 30 lakhs. Did you split there as per accounting standard? No. Plus, for 2 years, you recognize 1,50,000. So, premium 30 lakhs into 10%. This is the total amount of premium you need to pay. 2 by 4, you must have recognized. In exam, they will say different year. Again, here 50% concept. So, you need to understand that first 2 years, what entry you must have passed? Expense account debit to liability, expense account debit to liability. So, how much balance has come into this loan account now? 31,50,000. So, your balance of the loan as per accounting standard in the earlier balance sheet, as per accounting standard, the loan balance must have been 31.5. Correct? Okay, now let us see what would have been my balance as per the Ind AS if I would have done retrospective split on the day 1. You keep this aside. Today you have to reverse this. Will this loan be continuing anymore? No, because on day 1 in accounting standard they didn't split only. Simply one simple childish entry they passed. What is that? Bank account debit to loan. That entry was correct provided this instrument was at a market terms. Was it at a market terms? No, then how can you pass bank account debit to loan? So you passed one accounting entry bank to loan, chalo 30. And next to that a premium. In Ind AS what we will do with the premium? The 10% premium was there. What we will do in Ind AS? Adjust with what? What accounting entry I pass? Sorry? Adjust with EIR. EIR, I would have, because that would have got as an interest expense. What did they do? On SLM basis, they debited to P&L account. So now this is you keep now, working note 1. Working note 2, what is the book value of the debenture as per Ind AS? Transaction price. What is the transaction price? 30 lakhs. Less fair value of debt. You have got principal. How much? 30 lakhs into 1.10 into which present value factor I should take? 10% for how many years? And when I am doing this, this is on day 1. No, retrospective means on the day of issue of the loan. So I am trying to find out the fair value of the debt in 2001, 0.68. In the previous question, I didn't do it. I did prospective. Prospective means on the transition date. Retrospective means on the date of I took the loan. Clear, no? So how much it comes to? 22 lakhs, 44,000. That's it. Is this the principal? Interest is there. How much interest? 30 lakhs into 6% contractual rate into 3.17 present value annuity factor, 5,70,600. So 28 lakhs 14,600. If I take the balance 1,85,400, this is my equity component. So on day 1, I should have passed one accounting entry, bank account debit. That is correct under both the standards. Both debited to bank correctly. They took it to loan. But what I should have taken? I should have taken only 28 lakh rupees to the loan. They took full entire 30 lakhs. 1,85,000 I should have taken to the equity. They didn't take anything. Now, if this entry would have done on day 1, today, there would have been 2 accounts sitting in my balance sheet. What is that? One is equity. Is it subject to restatement? No. Because from 2001 to 2015, 2013, this balance would have remained the same. Will this balance remain the same from 2001 to now? What would have been its balance today? Now you say, sir, we have to prepare an amortization schedule. Prepare an amortization schedule. How many years? 2 years is sufficient. So my opening balance was 28 lakhs 14,600. Interest will be at what? 10%. EIR, be careful. 2,81,460. What is your CCF? 1.8. Feel good, control, no? When you do the final. Now see, after practice, it has come and sit in your mind, no? You understand exactly how it flows, what they do. Now what is your balance? 29,16,060. 29,60,060 plus second year interest will be 291,606. Again CCF. If at all I would have done these accounting entries on day 1, my loan balance today would have been 30 lakhs 27,000. Equity balance would have been 1,85,000 because it is not subject to any restatement. Now what transition should I do? I should de-recognize the book value as per accounting standard and recognize the split accounting as per Ind AS. And from now onwards, this amortization will continue. 1,85,000 I will keep it. And the day conversion is going to happen, then I will apply normal accounting. Beautiful, no? This Ind AS conversion. You see how much beautifully you bring that clarity. So transition accounting, 1, recognize book value of debenture rupees 30,27,666. This is on when? 1/4/2000. When I am passing entry? Yes, here, this side. When I am going to pass these entries now? When I am going to do this accounting? 13, transition date. Second, recognize equity rupees 1.85. Third, recognize liability as per AS rupees 31,50,000. That was the book value appearing in their balance sheet as per accounting standard. Now I will have one difference because of this. Okay, debit balance or credit balance? Yes. Fourth, debit retained earning rupees 63,060. Since you have done Ind AS 116, this should not be one difficult thing for you, restatement. This is what exactly we have done in Ind AS 116. Restatements. This is retrospective. The previous one was prospective. Prospective life is simple. Retrospective life again I have to go. That's why they have given you choices. Certain places no choices. They said liability is not there, no need to do it. But they have given you 3 options. No, one third option was very simple. From 2019 only you start by taking as if it is a new contract, new year. So there are different choices given. So what is my journal entry which is not asked in the question? Tell me. Simple, no? Convertible debentures account debit, retained earnings account debit. This one entry requires so much workings and understand. Keeping everything equal, assume like everything other adjustments are done. With this accounting entry, the accounting standard balance sheet is going to become Ind AS balance sheet. Clear? Actually, this was a mistake in the first study material. God knows some adjustments and all. For me, it was difficult to explain. Sorry? This amount is not matching. How much I told? 63,066. 1 minute, it's a typing error. Okay. Yes. Next question is a beautiful question. I told you, no. After solving this question, I understood what is transition. Otherwise, so much theory, so much headache, not understanding only retrospective. Okay, very nice question.